So for those of you who haven't heard of Eric before, senior ETF analyst at Bloomberg, you are the co-host of, I believe, the podcast Trillions and then the Bloomberg show ETF IQ. And I think this is going to be an enlightening conversation because right now with just my audience base, so much interest really in meme stocks and retail. And recently, as you were tweeting out, and that's what led to our initial conversation, is this whole idea of an inverse single equity ETF. So I want to get into that. And of course, we could talk about just really the craziness of the market in general, like high volatility, all of that. But it's always interesting to have these types of conversations because there's so many ways to handle what the craziness is. But as a Penn State alumni, I have to ask, how do you handle just the craziness of being a Rutgers fan? Maybe we should get that out of the way first.
Yeah, it's tough. And I'm in Philly. Philly's sports are no picnic either. But yeah, Rutgers is so bad. The good news, I went to a Rutgers game in the late 90s when I was there. Okay. And I remember this is before they were in the Big Ten. They were just bad and playing like Delaware and stuff and still losing. And a guy, I remember, the couple students had a beat visitor sign because they were so lazy and had so little inspiration. They thought, we'll just make a sign we can use all year. As opposed to actually like specifying for that game, just beat visitor. And it was just so like weak. And so I really just lowered the bar so much that when they come within like 2 touchdowns of Michigan, I'm like, wow, that's pretty good. So
I feel like I've done a similar thing with my trading. I'm like, oh, at least I didn't lose money today. And sometimes I still don't really clear that bar.
Look, listen, lowering the bar makes life a lot better.
I like it. It reminds me of
I'm really disappointed.
One of my high school teachers, one of his favorite sayings was, the earlier you fall behind, the more time you have to catch up. So I figure if I fall behind as early as possible, like I'm just optimizing the situation. But speaking about optimization, I just early morning finished your book, The Bogle Effect, and I really, really enjoyed it. And and I'm going to connect this with ETFs because in your opinion, it seems like this is an optimal way to be engaged in the market. So before we get into that, could you just lightly explain to the audience, like what is an ETF?
Right. So hopefully people know what a mutual fund is. You buy into this fund and the fund goes out and buys 30 to 500 stocks. So you're diversified. So the big thing about funds and ETFs is diversified. So AMC, obviously it's one stock. That's sort of like looking to go for a home run or a strikeout. You're like, Aaron Boone or whatever, Aaron Judge, sorry. Then there's ETFs, which are sort of a basket. And ETF is just a mutual fund that trades on an exchange. So it's almost like a mutual fund with benefits. ETFs also tend to be cheaper than a mutual fund, and they don't distribute capital gains, which annoys people about a mutual fund, where you get these tax bills pretty regularly because of what went on in the fund. An ETF, you only get a tax hit when you sell, if you made a gain, if you're lucky enough to make a gain. So what people love about ETFs is they can play the market almost like an economist or a long-term investor. So you can be like, okay, I've got my S&P and I've got my aggregate bonds. So I've got the main parts of the market covered. Over here, I want to add, I think China. I like the China story, but I don't know any stocks there. I'll just buy the China ETF. Gives me 30 China stocks, bam, just like that. You read something about cybersecurity. Maybe and you was like, oh, I can buy the cybersecurity ETF, put that on top. There's a meme ETF, which actually holds meme stocks. So if you're into this, you buy a basket of meme stocks, put it right on top. So ETFs, in my opinion, are still active investing in a way. They're just top down versus, say, going into an industry like the cybersecurity industry and analyzing 13 stocks and figuring out this is the one or two I like. That would be bottom up. So ETFs are more like top down active. And that's how people like to invest today. They like to invest more with this sort of view of everything and not just one niche area. Nothing wrong with being niche and analyzing stock by stock. Again, if you're right, you could hit a home run. But there are ETFs that are pretty volatile as well. So you can actually get some pretty juicy returns from ETFs. There's some leverage ones as well that some younger people like to play with. But generally, most of the money in ETFs goes to sort of the boring, we'll call it the Vanguard lane, the S&P 500 ETF, the total market. And they're basically free at this point, which is another reason it's sweeping the country, is because you buy VTI and you own all 4,000 stocks, basically 99% of the US market, and it's 0.03%. So you basically pay nothing to own everything. And people really really like that. I mean, who wouldn't, right? It's a pretty good deal.
One of the things that stood out to me, I don't know if this was in one of the interviews I saw or maybe a write-up, or this could have been in your book. Like I did this all in one together move. I believe the number you cited was John Bogle, for those of you who don't know. And to be fair, like I didn't know going into it. I read the book, and that was kind of the foundation of Vanguard. And Vanguard kind of now $7 trillion assets under management. It changed the game. It went from mutual funds to like, it was this massive rise of ETFs. And one of the biggest things was the fees. Like you're saving a lot on fees. And I believe the number you cited was he's saved the trading public, I think, $1 trillion in just fees. Is that right?
Yes, that's the number I got. And that grows by 150 billion each year. And 150 billion grows. So we're probably going to be looking at 3 to 4 trillion at the end of this decade. But yeah, here's how I came up with that. Vanguard, John Bogle launches a Vanguard index fund in 1975 at 46 basis points. The company is mutually owned. So anytime they get assets, the investors who are the owners vote to lower the fee. So it goes down 44, 43, 41, 40, 30, 45 years it took to get to 3. It wasn't overnight. So it was done really like this long, hard way, organically. And index mutual funds are where Bogle really started. That's the main part of what he did. And ETFs took the index fund concept and said, let's make it trade. So ETFs and index funds to me would be sort of together. And again, it's only cheap because of him. Nobody would really price these products at these fees if he didn't exist. And really, the most important thing is the company Vanguard is different. Most companies are owned by shareholders. Like Goldman Sachs is owned by a lot of people who own the Goldman Sachs stock. Well, of course, Goldman is trying to appeal to those shareholders, right? How? By making money, because they want dividends and cash flow. But part of how they make money is through their investors. So there's a tension between, I got to charge my investors more because my shareholders need money. Vanguard, the shareholders are the investors. So it eliminates the two masters problem and makes incentives really, it's a good incentive system to lower fees. And I found that interesting because nobody's copied it. It's really the only asset manager with this structure. And I was like, well, there's really no incentive to turn over all the future profits to the customers. Nobody does that in any business. And so I was like, well, why did this guy do it? And I just really wanted to explore this really weird dude with this really weird company that happens to be the biggest fund company 2 times over the world's ever seen, and will probably be the largest asset manager within like 3 or 4 years, passing BlackRock. And from there, it's just going to keep getting bigger. There's possible it does, plateau or something. But this year, for example, they're leading in flows again. They take in, more flows than anybody. This year they've taken in, I think, 90 billion. The rest of the fund industry is negative 250 billion. Wow. So it's in these years where Vanguard really increases their market share. And so that's part of why I wanted to write it, was not just the story and like why he did it, but the impact is astronomical. I mean, and about half the money goes to Vanguard. And then, a third goes to BlackRock, mainly in products that they just copied Vanguard, low cost beta. Yeah. And then in Fidelity, where they used to be the active fund, most of their money inflows goes into really dirt cheap index funds. So if you want money today, you sort of have to copy Vanguard and have these cheap index funds. And so that's really the effect. It's not just Vanguard and Bogle, it's the effect they had on everything. And if you would have invested all that money that's in passive and low cost into an active mutual fund, as if Vanguard never existed, that's where you get to the $1 trillion in savings.
Wow. I appreciate that framework, and I think that's going to make the rest of this conversation a little bit more fruitful. So like, to sum that up, and please correct me if I'm wrong, an ETF is a basket, and it helps like kind of de-risk the situation through diversification. And yes. The reason I'm stating it that way, and we're about to get into it, is kind of how like that seems to be at odds with that recent filing that we're going to be talking about. But before we do that, just because it is commonly discussed in the AMC ape community about votes and shares on loan, and I'm just not really sure how this works, so I'm hoping you could shed some light on it. If you look at the ownership filings right now on AMC, GME, Vanguard and GME, or BlackRock, they're the top ones. I mean, I think Vanguard as a company, maybe it's over 60 million right now, and BlackRock's a little bit less, and it's just because they're
We're talking GameStop, right?
Yeah, and I think AMC was looking at it, and it's just because
Who's RC Ventures?
that is Ryan Cohen.
Okay,
Yeah.
so after him, Vanguard is number 2 at 7.8%, BlackRock 6.7%. That's every stock, though.
Yeah. So I was wondering with that, obviously, I believe it's part of their business model. They loan a lot of those shares out, right? They're just going to take the interest payments.
They can loan, like a fund can't loan any more than a third.
Oh, okay. So a third of their total position is how much they can loan out, and then the other 2/3 it has to sit there. That's a SEC regulation, maybe.
Yes.
Interesting.
It's possible there's some wrinkle in that, but that's generally the rule.
Okay.
So
and then
you can't lend all of the stuff out.
Okay. And then in, I guess, a related note, when you have a big player like Vanguard or BlackRock, they don't commonly vote. Like if there's a shareholder meeting, like they're not sending
they vote. They vote.
They do vote.
Yeah. This is a huge issue in the industry.
Okay.
Because BlackRock and Vanguard are the top 2 owners of almost every stock now.
Okay.
And they have 15% collective ownership, and how they vote is pretty influential. So people study how they vote. And they get hit from the left and the right. Some people on the left say they don't like push climate change issues enough or diversity. And people on the right think they're too ESG. But I would say they're generally pretty just agreeable with management. I mean, I don't think they do anything too crazy. They're definitely not activists. But every now and then there's a controversial vote. And every time they differ. Remember, there was a time where I think Zuckerberg wanted to be the chairman and the CEO, something like that. And BlackRock said yes. Vanguard said no. So occasionally they'll differ even. So they do think about all the votes. They vote. They have these corporate governance teams at each company that look at all the information and then make their vote. But I would, if I'm thinking of BlackRock and Vanguard as owners, I think of them more as, sort of middle of the road voters. I wouldn't call them too far out in either direction.
Now, is there a chance? I was reading one of the recent AMC filings, and it just said, I believe that actually Vanguard had abstained. Like, do you think maybe that I just misinterpreted it, or is there a chance?
What was the vote? Was it something like related to meme stock investing, or was it? About
it was just, I think, with AMC, like a normal, like whatever there were of like, oh, should this be our accountant? Like, can this person get like this payment package? Like, I don't think it was anything massively influential on the company.
I don't know. It's a good question. I'd have to look at that individual issue, but. If you Google like BlackRock or Vanguard shareholder ownership report, something like that, they have these PDFs they put out every year and they go over all their votes.
Okay.
And there's filings. So you can actually dig in and look, and they typically vote. They might have abstained for a reason. Maybe they were split internally. I'm not sure.
Okay.
But it wasn't like they abstained because that's just what they do all the time. I think that was more of the outlier than the norm.
Okay, I appreciate that.
It's possible they abstain. I could see Vanguard and I could see them being like, you know what, AMC and GME are like, there's some weird stuff going on with these stocks. Mm-hmm. Let's just not vote because we don't want to impact or take a side. I could see them being a little bit like, because you know that phrase, they don't want smoke. You know, they don't want the smoke. I don't think they want any issue. They don't want bad press. They definitely want to avoid anything that optically looks weird or bad. It's possible that's why. I'd have to look, but that would be my guess.
All right, I appreciate that. Yeah, that was just out of my own curiosity. Now, so for the meat of it, and really the reason we're talking is, I believe it was rec shares, and now really since July, we have this rise of single leveraged inverse ETFs that start with like Tesla and like there's just various companies. And now fast forward to where we are at the start of September, it looks like the company Rec Shares has done it, I believe, on 10 different meme stocks where it is literally just the inverse of an individual equity. But that seems weird to me because as I was going through the book and just knowing ETFs in general, the whole point is diversification for de-risking. And this is just not that. It sounds like it's just almost giving people on an intraday basis, if they don't have a margin account, the ability to play an equity if they think it's going to go down on that day. It almost seems like very counterintuitive, and I'm confused about why the SEC is approving these. Like, it doesn't make sense to me.
Okay, first things first. Bogle hated this stuff, okay? Bogle was all about low-cost passive. He had problems even with Vanguard ETFs. He didn't like that you could trade them. He hated trading.
Okay.
He thought you should hold an index fund for 40 or 50 years so compounding could really do its magic and don't trade it. So he thought ETFs tempted you to trade, even broad market ones. Mm. When it came to this stuff, He called it the lunatic fringe. He did not like, I think he said nutcases and fruitcakes and lunatic fringe. And he was very colorful. He saved his most savage language for this kind of stuff, the leverage stuff, the theme ETFs. He thought it was all just pointless garbage. I will say that's where I say ETF and Bogleism are not necessarily the same. There are definitely some Vanguard ETFs, but the ETF industry is a big tent. And ETFs were really launched by the American Stock Exchange in 93 to get more trading on the exchange. They were launched to get trading going. They thought, let's take mutual funds and let them trade. Maybe that'll give us more volume. So they were launched to be trading tools. So the trading area of ETF, that side of the tent, is big. You got leverage ETFs. But by the way, SPY, which is a pretty S&P 500, that trades more than any stock every day. People use options on it. So even that is traded a lot. So when you have the trading community using ETFs as well as long-term holders, the trading crowd is open to a lot of things. And the reason single stock ETFs make sense and ETFs tracking, like oil futures, I call these trading tools, is that the ETF is like a ticker, like Microsoft, right? MSFT. You go to your broker, you click a button buy, and bam, that trade is on. To short Tesla would not be that easy. So a lot of what ETFs did and why they're popular also is convenience. They sort of have made everything trade like an equity, and people love how equities trade, right? So with ETFs, they trade just like Apple and Microsoft, but what's inside of them could be many different asset classes, many different things. Sometimes they actually package a trade. We're going to go long S&P 500 stocks, and then we're going to do put options to protect you on the downside. And you hit one button and you own that trade. And this is part of what is happening here. And so what they thought was, it's a pain in the ass to short. A lot of people don't want to go through the process of borrowing the stock if they even can, or using futures. We'll just do all that for them. So all this is doing the legwork for you to put that trade on. Okay. Makes sense? Now, how they're approved, it's tricky. They use swaps, and they probably, I got to look at the actual rules, but they certainly, it's possible they use treasuries.
That was a little bit.
There's certain little ways they can say, hey, we're diversified enough to get through. But it is head scratching that you're like, well, how could this be approved, especially with the spot Bitcoin ETF? That has not been approved, and yet they approve all this other stuff. There seems to be a disconnect, but technically these do check the right regulatory boxes for the SEC. But even the SEC commissioners have come out and said, we don't really think these should exist. They just technically, we have to let them through because they comply. But we don't really like that we did it, which is unique. But I can see how they feel like about this. But I'm fine with it. These products tend to never get that much assets. Like if you take all the leverage ETFs out there, I think they have like 2% of all ETF assets. That said, they make up about 9-10% of the trading. So, but that's what they should be used for. They are trading tools. So in this case, I would say 10% of them will probably thrive. I think 90% of them are going to be like low volume. Nobody cares. A couple will hit. Inverse Tesla is already a hit. Inverse GameStop and AMC, I don't know. Here's what I do know though. When it comes to trading tools, what usually works is stocks that have a big personality like an Elon Musk or the inverse Cathie Wood. People love SARK, or notoriety and volatility. And these meme stocks kind of have both. So they probably could find some takers for a while because they move so much. Anything that moves a lot is just going to attract that trading crowd because they're not there for retirement money or to, this is the side of the ETF wing that has nothing to do with Bogle and indexing.
Gotcha.
It's like this weird mutation. But ETFs, again, I always say they're a big tent. There's a lot of, it's like a zoo, right? Yeah. And the rabbit bunny exhibit's very different than the pythons, right? It's just, there's a lot going on in here.
That makes sense. So for clarification, just because this is something that's actively discussed, with this, when they make an inverse ETF, whoever is managing that ETF, I'm talking about like an inverse single equity ETF, they're not actually shorting it, right? They're constructing a net short position or that type of exposure through swaps and potentially other things such as futures, bills, notes, and that. Like, it's not like they're actually going out shorting and just saying, hey, we're going to package this up.
But here's how this is going to work. My friend Dave Nadig described a swap as like a high-end bar bet. So it's sort of like in The Big Short when those two guys wanted to get a seat at the table.
Yeah.
Or when Michael Burry went and said, "Hey, Goldman, can you make a arrangement with me where if the housing market drops, I get all this money?" That's a swap. And so all this company does, AXS, is it goes to different Wall Street banks and creates daily swap contracts, which are just bets that if Tesla goes down, I win. If it goes up, you win. And so what happens is if Tesla short gets, or let's say the AMC short gets, let's just say it gets $30 million inflows. They're going to go to Goldman and buy $30 million worth of swap contracts. Now, Goldman all of a sudden is very long Tesla, right? Because if Tesla goes down, they're going to be hurting.
Okay.
Right? Because they're going to owe the other person money. So what they do is they're probably going to go short Tesla to hedge their position. They don't want any risk. So even though AXS isn't shorting Tesla, somewhere it's going to get shorted. So if money goes into the ETF, it will result in short or selling pressure on the stock.
Okay.
Because
no
one in that chain wants any risk. They're not interested in making bets. They're just trying to service the bet.
Gotcha. Okay. I like the way you explain that. Makes sense. So like not them directly, but if you go far enough downstream, just because of classic risk management.
Selling pressure. So you guys, I saw everybody freak out when this got launched. I'm like, well, they probably won't get much money, so I wouldn't worry about it. But you should worry because if money does go in here, it will be like selling money. It'd be like pressure on the stock.
Yeah. Okay. I like that.
And it opens up the other side of the trade to a much wider audience who might not know how to short a stock.
But even with that, and just like with the rebalancing of swaps and everything, it sounds like it's an intraday thing and not necessarily a product that's meant to be held overnight. And then this is almost circling back to of our conversation with the SEC and what they do and don't approve. And the SEC, they're now putting out videos like for the retail community, be like diversification, be in it for the long term. Don't be an active trader. Don't treat it like a casino. And then it seems like this product is maybe not exactly that, but it's kind of close to it. Like that's what they're saying on an intraday basis. If you think this is going to go down, you should buy this. And then the fact that they won't even have a spot Bitcoin ETF, it really makes, I think, a lot of people, rightfully so, like kind of shrug their shoulders and say like, what the hell do we have going on here? Like you got to pick a lane and you got to stick to it.
I don't necessarily disagree. I'm okay with the big tent nature of ETFs. I'm not okay with the lack of approval of the spot Bitcoin ETF. I mean, we said 10 years ago, they should just approve it. It makes a lot of sense. And the more money that comes into the underlying Bitcoin market from these big market makers will help clean up the industry. It's good. They just don't see it that way. And if anything, I would say that's the real problem. They should just approve a spot Bitcoin ETF. Then there's no inconsistency. But you're right. It is weird they would approve these, but there's triple leveraged oil ETFs that have double the vol of an inverse Tesla. So if you're looking at straight volatility, there's much faster ways to lose money than an inverse Tesla ETF or a 1.2x Coinbase product. And also, I would argue that the whole options market, which you can get pretty easily now, you could really get some serious volatility going there. And obviously stocks, single stocks can go up and down quite a bit. So I would argue that a lot of it is a casino anyway. Look, the beauty is I'm a very free market capitalist kind of guy. The beauty is you could do whatever you want. You could buy Apple and hold it 50 years. You could buy the S&P 500 ETF and hold it 40 years. And then while you own SPY, so many people could have done all this stuff intraday, intra-week, intra-month. It doesn't matter. You're still going to get your return. So that's one thing I do enjoy about ETFs is they have democratized investing by bringing all this stuff out. Some stuff's a little risky though. When you open Pandora's box, you're going to get some weird stuff. That said, it's cool that everybody can now benefit from each other. First of all, they're all paying the same fee. There's no mutual fund issue where the people with the most money get the lowest fee and the least money pay the highest fee. Those are called share classes. ETFs are one share class. And it's all real cheap. It's like you get institutional level fee pricing. I like that. And that like SPY, all that volume in it keeps the spreads low. So when the long-term investor wants to get out, they're going to pay a very small bid-ask spread, like a basis point, largely because a lot of the big fish are in there trading all day. So it's kind of an interesting place where you get all these different player types playing in the same sandbox. So in general, I think trading is a big deal. And Bogle, he could not stand SPY. SPY, the assets in it turned over 3,000% a year. So let's not even go to the crazy stuff. Bogle was like that. Who would trade the S&P like this? So the beauty is you could be a Bogle and have your money in the stock market and wait 50 years and take it out. And all this shit could happen. I enjoy this. I'm okay with losing money. Then you can bet on sports. You can go to the casino. So this is fine in my opinion. And when I said on Twitter that to the meme stock crowd, if your goal is to have fun and like get a community going and like the rise and fall and like and sort of engage with Wall Street that way, I think that's fun. I have no problem with that. But if your goal is to sort of stick it to Wall Street and be like, you have this populist uprising, I was just saying that the way to do it is to just buy and hold a total market index fund for 3 basis points. Because the way Wall Street makes money is they're the middleman. They're like the casino. They're like Harrah's Casino. So if you buy an index fund, you're leaving the casino because you're not. Index funds rarely move the stocks inside. It's like static, pretty much. Okay. So there's no trading. No money is moving around, and the index fund itself charges 3 basis points. So both the buy side and the sell side, which is both sides of the Wall Street umbrella, make no money. It's leaving the system, which is why I refer to Bogle as the OG of DeFi. I think he generally had DeFi spirit going on, but he would not approve of the meme stock trading, but he would also not approve of somebody trying to trade Apple and Microsoft all day. So it's not necessarily the meme stock. And I would say that to somebody doing the Apple Microsoft trade too. It's just that generally people trading Apple and Microsoft and options, they're usually doing research and trying to win. The meme stock thing has this sort of revenge factor baked into it a little bit.
100%.
But, if you look at the volume on AMC and GameStop, I was calculating it makes a lot of money for the Citadels of the world because of the spread on the stock is a little higher. And that's who's sitting in the middle. So you sell it for this, but they'll offer it for this and buy it for this. And that difference is what they take in. And the more money goes back and forth over that line, the more they get. It's like a toll collector. Yeah. So I was just saying, why pay? The problem with my plan is it's very boring and it takes a long time. It's like planting a seed in the ground. And you got to wait 30 years for the tree to grow. And so I acknowledge that if that just sounds too boring, then just be honest with yourself that your real goal is to have fun, meet friends, play volatile markets. Fine, just be honest. But if your goal is to sort of like, stick it to Wall Street or something, it just seems like there's no better way to do it than an index fund. And by the way, you're going to build wealth. But I don't know. What do you think of that? Like, I got a lot of people who were like, "Oh, he's part of the enemy. He's Bloomberg." I got pretty beat up for that, but I thought it was pretty sound. I don't know. Am I off here? Yeah,
I mean, well, I just want to we are a little over on time. Is that all right if we talk a little bit more? I just want to be respectful here.
I got about 10 minutes.
Okay, 10 minutes. I think it's that, like, comically, I start all my streams, like the bell rings, I say the casino's open. And to me, I mean, if I'm being completely frank with you here, even some of the community like has now been alienated to me. There's a very small minority that is a very loud minority. They find themselves on Reddit, they find themselves on Twitter, and sometimes it's the inmates are running the asylum. And I think the people who are informed and are interested in true dialogue and learning about the markets to maybe improve their financial situation or just to learn a new skill set, sometimes they look at it, they're like, I'm a grown adult, I don't need this drama. So they choose to stay quiet. Like, I think there is some sort of breakdown of who uses this type of a thing. And I don't know, when this all started for me, it was more of, I think there was a cultural thing going on. It was a pandemic. People were locked up. They had the stimulus checks. So they were looking for a form of a community. Then they were also told this community's fighting Wall Street. So there was a very endearing story of David versus Goliath. And they start to learn about short interest. They're like, wait, it was shorted 100%. People bought into it. It got a little bit of traction on mainstream media. And then all of a sudden the buy button was taken away. So the start of it, there was this very, very compelling story that I loved and millions of people loved. And with it, though, it's kind of similar to the 24/7 media cycle. the community itself seems to like need everything every day. So when someone like you is just pointing out information and sharing of like, hey, like long-term investing, it's proved to work for millions of people, maybe try that, you are viewed as an enemy. And it's easy to overlook certain things if they don't want to acknowledge it. I was just reading, I think Citadel had a banner year. They're a market maker. Your analogy of the casino, they are the house. If people are on the slot machines, the law of large numbers, they're making money. And there's just this thing of like, what you're saying is, well, just don't go give them your money. Like, just don't do that. If you don't go into the casino, like you're good. Like, and you're saying one other avenue to maybe do a different game is you get an ETF, you work, you retire a couple decades later, and you have a nice 7%, 8% compound growth, whatever ETF you pick. I see what you're saying there. And it is interesting. I feel like the ape community, it's at like this interesting part where at one point it was stick it to the man and maybe we can make some money off of it and fix a part of Wall Street. And I think most of it is still truly like that. But then there's people who, I mean, I even read it under your comments that like you're kind of getting attacked. And to me, it's a little bit of an embarrassment because then there's people in your position who are willing to have these types of conversations and teach retail a little bit just so they have a little higher chance of being successful. And fortunately, you were willing to take this conversation, but then there's others who haven't. They're like, dude, I just saw it's not worth it. Like, I'm an adult. I have things to do. So it's at odds. And I just hope that silent majority is like going to be steadfast and like is willing to learn about the market. Because to me, I don't think humanity has ever made a better vehicle for wealth creation. Like, I want as many people to be in the market as possible in any form or capacity just to learn and learn and learn. But it's a tough thing to stress that it's not necessarily learning to just like scream at people on Twitter. Like, that's just not learning. One, a little anecdote, and I know I'm going off here. Cliff Asness from AQR, one of the most respected people in Wall Street, he pointed out that he had like a micro AMC put position or like short position just because it's what his algorithms told him. And the amount of attacking he got, everyone was acting as if he was massively short, yada, yada, yada. And he attacked. And then he even said, and then all I could think in that moment, I was like, man, imagine if we somehow like were endearing to him and got him to talk with us and to pull back a little bit of the curtain of how Wall Street works. Tell us a little bit about these high frequency trading machines. Like, it was a learning opportunity that I think because of the ravenous nature, like disappeared. But then the other part of it is like, that ravenous nature, this kind of the circus that we were talking about, well, that's also how it got so big anyway. So like, I don't know if you could have one without the other. Like, and I've been thinking about it and it'll be interesting to see how it all plays out.
Yeah, no, Cliff is a quant. So whatever quantitative data, like whatever metrics AMC was spitting out, it just, the computer program said it should be short. Mm-hmm. He was nothing personal with him. It wasn't like when the other firm at the beginning, Melvin, shorted GameStop, and you were like, "Oh, I want to short squeeze this hedge fund." That was obviously it worked. And they truly hated that. They thought the company was overvalued and hated the business. Cliff's different. He's more of a quant. He does not really looking at companies that way. That's what I think he's trying to explain to everybody. But I guess he's a hedge fund manager, so they're just like view him as. I mean, I got lumped into that, but as like the man or whatever. But it's like I said, if you I just think if the self-awareness is there to say like, I almost say the same thing about like ESG people. Like, look, buy an ESG fund, which screens out like, polluting companies and, the oil and this. And I'm like, but you actually you have a car and you fly a plane. So you're contributing to the profits of the said oil company. Well, just to be honest with yourself that you're just buying the fund to feel good. Yeah. I just say, just be honest with yourself. If you're doing this for fun and community and to like scratch an itch, no problem. Yeah. I wouldn't go around thinking this is the way to stick it to the man. I just don't think that's true. And I've come to the conclusion that a very simple, low cost, untouched portfolio is the best possible way to get the most of your money, which in turn starves the casino. Again, it's just that's why I wrote the book. The Bogle effect it's growing and growing. That said, there is definitely the advent of free trading and the internet has certainly made trading interesting for retail as well. But my theory on the memes and even some of the crypto is they're usually young people. My generation lost their mind on Oracle and Microsoft and stuff in the 90s. And I remember like my roommate traded these stocks and he thought he was a genius. And then obviously the market crashed. At the same time, we all got older. You know, some people got married, maybe had kids, bought a house. And then you're just too busy. And, you know, your significant other probably isn't going to like you losing money in the market. So I personally think each generation goes through a process where they trade and they like to trade. It's exciting. It's interesting. I think a bear market and, you know, aging you pivot into the more boring stuff. So perhaps maybe they'll just remember what I said when they finally get to that point and they'll go, yeah, I'll just do that. So I think that the meme stock trader of today is probably the Vanguard investor of tomorrow.
It'll definitely be interesting to see how it plays out. I know we're over on time, but I also really like how you put that of like the starving the casino. I definitely want to think about that, but I truly appreciate your time. If you, like I said, he is the co-host of the podcast. Well, actually, it's all in your Twitter bio, so I'm going to link it below. But you're an ETF IQ, you're in Trillions, senior ETF analyst at Bloomberg. If you want to shout it out now, just your Twitter handle, and then I'll make sure to link it below so people, if they want to follow up with questions, they can do so.
It's just my name. Believe it or not, it was available. At Eric Balchunas.
Awesome. Well, I'll get that out there. We'll clip this up and we'll just get everything so people can find all the necessary information. But once again, I appreciate your time. Thank you so much. And hopefully we'll be talking soon. Have a good one.
Yeah, you too. Thank you very much. This was fun.